Hello everyone, welcome back. Today we will be walking through tax AOs that deal with salaries versus dividends versus bonds in CPA cases. The structure of Canadian taxes is meant to charge the same level of income tax regardless of if it is earned through a salary or a dividend on an individual and corporate level. This is known as integration. However, this is not a perfect model, and there can be potentially a benefit of receiving one form of payment over another. When assessing salary versus dividend AOs, CPA candidates should write a balanced qualitative analysis and demonstrate understanding of various tax topics. Several examples will be provided throughout this video that you can use throughout your analysis. Step 1, we will be assessing salary payments. One of the benefits is that you will receive a deduction in the calculation of corporate taxes, therefore reducing the taxable income. Paying salary also generates earned income from childcare deduction purposes on a personal level, and this allows you to deduct childcare costs if you have any children and meet the specific criteria. Being paid a dividend will not allow the same cost deductions, giving you an overall higher taxes payable. Deducting salary payments from corporate taxable income can be used in tax planning to decrease income below the $500K small business limit to achieve a lower tax rate when calculating taxes payable. Another benefit is you will receive payments from the CPP program later in life when you retire, and this is an effective and stable form of pension planning. Generating earned income through a salary will also create RRSP room. This will allow you to put funds aside for your retirement and receive a tax deduction in the year of contribution that will reduce your overall personal tax liability. Lastly, a major benefit of a salary is that it creates more predictive and steady income. From a personal standpoint, this can make obtaining loans, mortgages, and other debt easier as the bank can assess your ability to comply with payment criteria. From a company perspective, this is beneficial for planning monthly cash outflows as well. Now looking at some of the cons in paying out a salary, the first being that it will be included in employment income in the year received and taxed personally using increasing tax brackets. This will often result in higher taxes payable from a personal perspective. Additionally, paying out a salary requires payments into the CPP program for both employer and employee portions. This could result in reduced net cash flow available due to CPP costs associated with this payment. Another con is that it reduces the financial results of a company as the salary payment represents an ongoing expense. This could impact the company's ability to obtain financing in the future. One last con is that you need to determine a reasonable salary, otherwise amounts cannot be deducted and tax filings may be increased, or you may need to amend prior periods, which could actually increase your taxes payable. Moving on to step 2, we will now assess paying out dividends. One of the major pros in paying out a dividend is that it provides greater flexibility as dividends can be paid out based on how much the business is performing. Therefore, if the business is performing well, more dividends can be paid out, and if the business is performing more poorly, you can hold out on paying out any dividends. Capital gains produce amounts for a capital dividend account known as CDA, and this can actually be paid out as a tax-free dividend in the future. Interest and capital gain income earned from investments will be considered property income. This will be subject to additional refundable tax, creating an RDTOH balance. And in this case, by paying out a dividend, the company will receive a dividend refund by paying the general corporate tax rate. Another pro is that net profit is not reduced by dividends, and they are not considered to be a business expense, therefore showing more favorable results, which could be preferable when viewed by potential lenders or investors than as opposed to paying out a salary. The last pro is that there's actually a greater opportunity for income tax planning. For example, there's the opportunity for income splitting that can be achieved with 2 or more shareholders, for example, a husband and a wife. In relation, dividends reduce an individual's cumulative net investment loss. When claiming the lifetime capital gains exemption, the cumulative net investment loss will diminish the amount available. Receiving dividends as payments will reduce the existing cumulative net investment loss balance and will increase the lifetime capital exemption available in the future. Now we can look at some of the cons in paying out a dividend. One of the major cons is that this actually increases company taxes payable. Dividends are not deductible like salary payments, therefore this increases the income. However, dividends will be paid out of after-tax profits and be eligible for a dividend tax credit, which, assuming integration is working, will offset the higher corporate rate of tax paid. Therefore, they reduce the cash flow and do not decrease corporate income taxes. Another con is that paying out dividends do not generate RRSP contribution room and pensionable earnings for CPP, which can be an issue for a personal individual planning for retirement. One last con is that dividends are issued and paid based on share ownership. This can be challenging to allocate different amounts of income to various shareholders. Lastly, let's now assess paying out a bonus. We can first look at the key benefits to paying out a bonus. The first being that bonuses declared at year-end create the opportunity for a personal tax deferral, since the amount does not need to be paid for at least 6 months later. Bonuses can often be directly deposited in an RRSP account, which reduces the amount of taxes paid compared to receiving the bonus in cash directly. The owner of a company can set a bonus amount once the company's earnings have been determined, ensuring the company maintains positive income, opposed to the salary, which gets predetermined before. This therefore offers more flexibility in the amount of the bonuses that can be paid out. Lastly, a CCPC can declare a bonus to reduce corporate profits, thus resulting in a lower tax rate. Next, look at some of the cons for paying out a bonus. If a bonus is declared and not paid out right away, cash flow issues later could create difficulty in actually paying the bonus out. Additionally, paying a bonus like a salary comes with a higher cost in terms of employer and employee portions of CPP that must be factored in. Another con is that the personal tax rate of bonuses is significantly higher than a salary, for example, which results in more taxes to be paid on the personal individual level. In conclusion, when preparing a final recommendation considering bonuses, salaries, and dividends, there are several factors to consider. In CPA cases, recommending between these options is not a decision of exclusively picking one over the other. You should recommend a variation between these alternatives that uses the most optimal case facts. For example, you can recommend the user to choose a salary large enough to qualify for the maximum CPP benefits and RRSP contribution room to ensure effective retirement planning. Any excess beyond this amount can then be paid out in the form of a dividend, for example. Deciding which combination will result in the least net taxes will be dependent on several other factors. For additional pros and cons, check out the full blog post. The link will be in the description and has several other items on the list that we did not discuss here today. Now you're ready to prepare an analysis on how to recommend ownership payout under tax.